There's a vault in Beijing that holds the key to American power. Inside, China's foreign reserves sits over $3 trillion in assets, much of it tied directly to the United States economy. This single stockpile represents the largest accumulation of foreign wealth in human history. Yet the nation that holds this fortune cannot spend it, cannot sell it, and cannot escape it without triggering its own economic collapse. This is the paradox of modern economic warfare. China holds enough American debt to theoretically crash global markets. The United States depends on China to keep financing its mounting deficits. Both nations are locked in an embrace that neither can afford to break. This isn't cooperation. It's a stalemate disguised as interdependence, and the cracks in this arrangement are already beginning to show. Before we understand China's trap, we must understand the pattern itself. Reserve currencies don't emerge by accident. They follow a predictable trajectory. First comes economic dominance through manufacturing and trade. Then comes military reach that protects global shipping lanes. Finally comes the financial infrastructure that makes one nation's currency indispensable for settling international transactions. But what history teaches us is that dominance is never permanent. For most of the 19th and early 20th centuries, the British pound sterling ruled global finance. At its peak, the British Empire controlled a quarter of the world's landmass and population. London was the center of international banking, and the pound was the currency that facilitated global commerce. But World War I shattered this system. Britain borrowed heavily to finance the war, accumulating massive debts primarily to the United States. By the time World War II ended, Britain was financially exhausted. The pound's share of global reserves declined from over 60% in the 1940s to less than 5% by the late 1970s. The transition wasn't sudden. It took decades. The Bretton Woods Conference in 1944 officially crowned the US dollar as the new global reserve currency, backed by American gold reserves and economic might. But even this system proved temporary. On August 15, 1971, President Richard Nixon unilaterally ended dollar convertibility to gold. With American gold reserves depleting due to Vietnam War expenditures and growing trade deficits, Nixon closed the gold window, effectively ending the Bretton Woods system. This moment, known as the Nixon shock, could have destroyed dollar dominance. Instead, it evolved into something more powerful. In 1974, the United States struck a deal with Saudi Arabia that would reshape global finance. The Saudis agreed to price oil exclusively in dollars and to recycle their petroleum revenues into U.S. Treasury securities. In return, America provided military protection and equipment. This petrodollar system meant that any nation buying oil, the lifeblood of industrial economies, needed dollars. Suddenly, the dollar wasn't backed by gold, but by the one commodity every country required. This arrangement gave the United States what economists call exorbitant privilege, the ability to print money that the rest of the world must hold. China's economic transformation began with a calculated gamble. When China joined the World Trade Organization on December 11, 2001, it gained unprecedented access to Western markets. The results were staggering. In 2001, the U.S. trade deficit with China stood at approximately $83 billion. By 2024, the figure had exploded to roughly $295 billion, a more than threefold increase. China became the world's factory, producing everything from electronics to furniture, from textiles to machinery. But this export boom created an unavoidable consequence. China began accumulating massive amounts of US dollars. When Chinese companies sell products to American consumers, they receive payment in dollars. These dollars flood back into China's banking system. The People's Bank of China must then do something with this tsunami of foreign currency. They can't simply distribute dollars to Chinese citizens for domestic spending. China's economy runs on renminbi. So they exchange the dollars for newly printed renminbi, adding the dollars to China's foreign exchange reserves. By June 2014, China's foreign reserves peaked at nearly $4 trillion, the largest accumulation of foreign wealth in history. The question became, what do you do with $4 trillion? You can't keep it in cash. Inflation erodes its value. You need safe, liquid investments denominated in dollars. And there's only one market deep enough and secure enough to absorb that volume, U.S. Treasury securities. At its height in November 2013, China held approximately $1.32 trillion in U.S. Treasury bonds. As of September 2025, China still holds roughly $700 billion in treasuries, making it the second largest foreign holder after Japan. When you add treasury bonds to other dollar-denominated assets, corporate bonds, agency debt, equities, China's total exposure to the dollar system approaches $3 trillion. This is where the trap closes. China built its economic miracle on export-led growth. Manufacturing accounts for 99% of China's total goods exports. Approximately 18 to 20% of China's GDP still depends on exports, with the United States historically representing one of its largest single markets. To keep this export machine competitive, China must maintain a relatively weak currency against the dollar. If the renminbi appreciates too much, Chinese products become expensive and lose market share. To prevent depreciation, China must recycle its dollar earnings back into dollar assets, feeding the very system it wishes to escape. This is the fundamental architecture of the trap. The 2008 financial crisis revealed just how deeply China had become embedded in the American economic system. When Lehman Brothers collapsed in September 2008 and global markets froze, conventional wisdom suggested China would dump U.S. assets and run. Instead, China did the opposite. Between 2008 and 2010, China actually doubled its holdings of U.S. Treasury bonds. In 2008 alone, China provided close to $500 billion in financing to the United States. Why? Because China had no choice. Selling U.S. Treasuries en masse would have caused Treasury prices to plummet and yields to spike. This would have inflicted massive capital losses on China's existing holdings, potentially hundreds of billions of dollars evaporating overnight. Moreover, a Treasury sell-off would strengthen the renminbi as dollars flooded back into foreign exchange markets. A stronger Chinese currency would devastate export competitiveness precisely when global demand was collapsing. China found itself in the darkly ironic position of rescuing the same financial system that had just nearly destroyed the world economy. This episode gave birth to what economist Paul Krugman termed China's dollar trap in a 2009 article. China owned so many dollars that it couldn't sell them without triggering the very capital losses and currency appreciation it sought to avoid. The nation had become the prisoner of its own success. Every additional dollar earned through trade made the trap tighter. Every additional treasury bond purchased deepened the dependence. China was like a creditor who has lent so much money to a debtor that the debtor's failure would bankrupt the creditor. The interdependence had become total. This creates what analysts have termed financial mutually assured destruction, an economic version of Cold War nuclear deterrence. China cannot aggressively sell U.S. debt without destroying its own wealth and crippling its export economy. The United States cannot afford to lose China as a major purchaser of treasury bonds without seeing borrowing costs spike, potentially triggering a fiscal crisis. Both sides are locked in an embrace that neither can escape without suffering catastrophic damage. Consider what would happen if China attempted to weaponize its treasury holdings. A large-scale sell-off would initially drive up U.S. interest rates as treasury prices fell. American borrowing costs would increase, potentially slowing economic growth. But the consequences for China would be far more severe. The sell-off would cause the renminbi to appreciate sharply against the dollar. Chinese exports would become immediately more expensive in dollar terms. American consumers would shift purchases to cheaper alternatives from Vietnam, Mexico, or other competitors. China's export sector, still employing hundreds of millions of workers, would face massive disruptions. Meanwhile, the capital losses on China's remaining dollar holdings could exceed hundreds of billions of dollars. The data supports this logic. Despite rising geopolitical tensions, China has been reducing its treasury holdings gradually, not abruptly. From a peak of $1.32 trillion in November 2013, holdings have declined to around $700 billion by September 2025, a 47% reduction over 12 years. This is a managed retreat, not a panic exit. China sells slowly, careful not to trigger market disruptions or sharp currency movements. Meanwhile, the United States has grown its national debt from roughly $6.4 trillion in 2008 to over $36 trillion in 2025. Foreign holders now own approximately 30% of U.S. debt held by the public, down from 34% in 2013, but still representing about $9 trillion. China's share has declined from 15% of foreign holdings to roughly 8%, but the absolute sums remain enormous. In 2024 alone, the United States paid $230 billion in interest to foreign debt holders, money flowing out of American taxpayers' pockets to creditors abroad. The dollar's role as the world's reserve currency is slowly eroding but not collapsing. As of 2025, the US dollar still comprises approximately 58% of global foreign exchange reserves, down from over 70% in 2001. It accounts for 88% of global foreign exchange transactions and 54% of global trade invoicing. No other currency comes close. The euro represents 20% of reserves, the Japanese yen 6%, the British pound 5%, and the Chinese renminbi just 2%. Yet China is methodically working to reduce its dollar dependence. As of 2025, more than 30% of China's trade in goods and services is conducted in renminbi, up from 14% in 2019. China settles over 50% of its cross-border transactions with Russia in renminbi. China has gradually decreased its dollar assets from 59% of total reserves in 2016 to approximately 58% in 2023, diversifying into gold, euros, and other currencies. These shifts are incremental but directionally clear. China is also pushing renminbi internationalization through the Belt and Road Initiative, establishing currency swap lines with dozens of countries and creating alternatives to the Western-dominated SWIFT payment system. The BRICS nations, Brazil, Russia, India, China, and South Africa, recently expanded to include additional members, have discussed creating alternative payment systems and potentially a new reserve currency. While these efforts face substantial obstacles, they signal China's long-term strategy. The fundamental problem for China remains the same. A currency cannot become a true global reserve without deep, liquid, and open capital markets backed by rule of law and property rights protections. China maintains capital controls that restrict money flows in and out of the country. Its financial markets, while large, lack the transparency and legal frameworks that make investors comfortable parking trillions of dollars. Most importantly, a reserve currency requires trust that the issuing government won't arbitrarily confiscate or freeze assets. Trust that China has yet to earn globally. Here's what the conventional narrative misses. The trap doesn't just constrain China, it constrains America too. The United States has grown dependent on foreign capital inflows to finance budget deficits that now routinely exceed $1 trillion annually. This dependence limits American policy options. Aggressive decoupling from China could disrupt the Treasury market, raising borrowing costs precisely when debt levels are at historic highs. The Federal Reserve's ability to raise interest rates to combat inflation is constrained by concerns about debt servicing costs. America's exorbitant privilege has become an exorbitant burden. The privilege of printing the world's reserve currency comes with the obligation to run persistent deficits to supply that currency to the world. Meanwhile, China's export dependence has created massive domestic imbalances. Decades of undervaluing the currency to boost exports have suppressed domestic consumption. Chinese households save at extraordinarily high rates because wages have been kept artificially low relative to productivity. Real estate became the primary store of wealth, inflating a property bubble that began bursting in 2021. Local governments accumulated debt worth trillions of dollars. The export model that built China's wealth now constrains its transition to a consumption-driven economy. China's demographic crisis, shrinking working-age population due to decades of one-child policy, makes this transition even more urgent. The deeper truth is that both nations have built their economic strategies on foundations that are becoming untenable. The United States cannot indefinitely accumulate debt equal to 130% of GDP, debt that requires constant refinancing at the mercy of global bond markets. China cannot indefinitely rely on exports to wealthy nations that are increasingly viewing it as a strategic rival. The current system works only as long as both sides pretend it can continue forever, but economic gravity eventually asserts itself. We began with the image of a vault in Beijing holding $3 trillion. But the more accurate image is a chain, forged link by link through decades of trade surpluses and treasury purchases that now shackles both nations together. China cannot escape without destroying its own wealth and export competitiveness. America cannot function without foreign creditors willing to finance its deficits. This is the modern architecture of economic power, not domination, but codependency, not strength, but mutual vulnerability. History teaches us that these arrangements eventually break. Sterling didn't fall because Britain wanted it to. It fell because economic realities made the old system untenable. The Bretton Woods gold standard didn't end because it was working. It ended because America couldn't sustain it. The question isn't whether the current dollar-centric system will change, but how and when. Will it be a managed transition over decades or a crisis-driven rupture? Will China successfully internationalize the renminbi, or will another challenger emerge? Will the dollar remain dominant through American economic renewal, or through the absence of viable alternatives? The trap that holds China holds America too. Neither can escape without pain. Neither wants to be the first to break the chain. So they continue the dance. China slowly diversifying away from dollars while still holding hundreds of billions in treasuries. America running deficits while worrying about the day foreign buyers balk at its debt. Each nation controls the other's fate, just enough to ensure neither acts rashly. This is the paradox of modern economic power. The creditor needs the debtor as much as the debtor needs the creditor. In the end, the $3 trillion trap reveals a fundamental truth about 21st century economics. In a globalized world, there are no winners and losers, only participants in a system so interconnected that everyone's success depends on everyone else's stability. The question we should be asking isn't who will win this economic competition, but whether either side can afford for the other to lose.